Pick the right stock at the right time.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching IndianOpen. Let's go straight to the headlines at this hour. The UK Parliament votes against leaving the European Union without a deal, opening the door to delaying Brexit and rewriting the terms of divorce. The United States joins the group of countries that have grounded the Boeing 737 MAX jets after evidence linked the Ethiopian Airlines crash on Sunday to the Lion Air crash in October. The Reserve Bank of India plans to infuse 35,000 crores of liquidity into the financial system through dollar-rupee swap auctions on the 26th of March. And Lemon Tree signs a non-binding agreement to acquire 100% stake in Keys Hotels. And we'll talk about all of these things on the show today. It's a reasonably packed next couple of hours of trade. Lots of stocks to react as well. So interesting session of the trading day. Let's first take a look at the trade setup for the day. 2 or 3 things that will have a bearing on how the world markets have done and how the Indian markets could do as well. Let's start off with the news around the world firstly. One, of course, what's happened to the world markets, and a precious little you would have to say, because it's not that the US markets have really had a very strong reaction overnight. It's about 0.5% or thereabouts, led predominantly by Nasdaq once again, and arguably the big drag on the Dow, Boeing, not as big a drag yesterday as it has been the last couple of days. So the US markets had a day in the green, and the world markets, other world markets are following suit as well. But the news flow and fair degree of news flow on the world markets as well in trade yesterday. Firstly, the US lawmakers voted against the proposal for a no-deal Brexit, so that has been averted. Now the question mark is, as the headline stated, what the new deals of the divorce as and when they get happen. There is an uptick in crude prices overnight because of the falling crude stockpiles, and the question mark is, thus far Indian markets have stayed fast against the stubbornly sticky crude prices at those $66 per barrel for Brent. Now that we are at 68 or thereabouts, heading towards 70, would the Indian markets react? That is one key question. Would the oil and gas space react? That's the other key question. So I think that's something that we'll monitor as well. And in amongst other news, something that a lot of people were hoping will not happen, but inwardly suspected would happen. China has blocked again the move in the UN to declare Masood Azhar as a global terrorist. This happened at about 11:30 p.m. India time. But in geopolitical news, this was arguably one of the most important news from an Indian perspective, and that has certainly happened. Not that it's a big market impact, but nevertheless, keep this at the back of your mind too. What about the trade setup for the day? We've seen the last 2 or 3 sessions that the moves have been led by the banking space. And yesterday was no different, by the way. Big, strong surge in banks. It almost seemed a replica of what happened day before yesterday. But the interesting thing is that these stocks are being bought on above average volumes and above average delivery volumes. That's the key thing. This is the change in volumes. Look at the kind of surge that happened in HDFC Bank and IndusInd Bank, even HDFC, but banks predominantly, the kind of surge in volumes that came about, and then the delivery based buying that we're seeing in each of these. So this is as of March 12th and March 13th. I've put both the days together. And look at that, even though IndusInd Bank may have come off from 45 to 40%, 40% is a reasonably okay number for a large bank which would see heavy trades. HDFC, 62%, HDFC Bank, 79% and 76% delivery-based buying. Now you know, you can put 2 and 2 together and figure out where the FI money has gone. We've seen unabated flows from FIs the last few days, and you can now sense as to some part of the money has definitely gone to the banking stocks. Look at that. The last 5 days, again, 1,000 crores was the norm until last week. This week has been punctuated by really large volumes, 3,800 crores, 2,500 crores, 2,700 crores as of yesterday. The averages are consistently moving up. Yes, DI sold about 1,500 crores yesterday, but the FI flow has been very, very strong, and that's impacting on the Bank Nifty And at the other hand, it's impacting the rupee because the currency too has been gaining strength. In yesterday's session as well, the rupee only inched up higher, 69.53. There's some news as well which we'll talk about, but the RBI is going to inject domestic liquidity via forex swap too. But I would suspect that the larger trend is a result of flows that are coming into the equity markets and maybe the other markets too, as a result of which the currency has strengthened quite considerably. So that small impact of crude prices inching up, getting negated in part by the strength in the rupee. The question mark only is, do we now see the impact with crude at 67.5? Anyways, we'll get to know about it when we get to know about it today. We're likely to start off flat because the world markets, the Asian markets are a mixed screen. Nikkei about 0.6%, Shanghai down about 0.25%, Hang Seng about 0.25% higher, and the SGX Nifty, after having a rollicking move the last few days, is showing some signs of a tempered move. I don't think people should be disappointed with this. You really can't have the markets going up every day. Trees don't grow to the sky. Let's talk about specific stocks though that we will monitor in the session today. Lupin, there's a regulatory action. The US FDA has classified the Mandideep facility as an official action indicated, so OAI status. Now, is it a piece of bad news? Yes, it's not good news for sure, but it's not really that dramatic. The stock has already reacted a bit in trade yesterday. We were wondering as to why is it that Lupin has done what it has done, likely because of this. But 5% downtick already yesterday. Don't quite know how big a move this will have. But yeah, it's certainly a thing to monitor. There's a new acquisition by Lemon Tree. They've signed a non-binding agreement. By the way, it's just an agreement as yet, but it's a non-binding agreement to acquire 100% stake in Keys Hotels, and a fairly large acquisition of sorts. Adds, if you take the company-owned plus leased plus managed properties at somewhere around 5,400 properties, then this adds another 15-20 odd % by virtue of the number of keys that come in. So it's a fairly large acquisition in that sense, not something that we've seen in the hotel space for a while. Let's see if there's a bearing on Lemon Tree Hotels. We have no inkling as yet about the quantum that they've paid, etc. But I'll talk about it a bit later on in first word, so won't dwell too much on this. But watch out for this stock, could be an important one today. Jet Airways, and the troubles keep on mounting. 5 more planes have been grounded due to non-payment to lessors. This happens every single day. Let's wait and watch if today could be a day of reaction. Add to that, crude is higher. Maybe that has an impact too. And Jubilant Foodworks will certainly be the stock in focus. The promoters are going to sell about 40 lakh shares at a floor price of 1,272 per share. We've seen what happens when floor prices are attached. They have to be attached, but typically in almost every single block deal, OFS or a promoter stake sale that happens at a particular price, the stock tends to react downwards. I'll be really surprised if Jubilant Foodworks doesn't start off lower today. Let's tell you what's lined up on first word today though. It's a collection of the top editorial stories that we believe we should bring to you. Administered gas prices may touch a 3-year high, indicates a Bloomberg Quint survey. Sameet Sarkar takes us through the details. Lemon Trees decided to go shopping, but does its balance sheet have the strength? I'll try and take you through some of the finer points with the limited information that we have as of now. Nestle has drawn up a cluster-based approach to grow in India, and that's paying dividends so far. Agam tells us how and why. And then Yatin Johnson to talk about what's fueling the rally in power stocks of late. The government, in keeping with higher crude prices, is expected to hike administered gas prices for the 4th time in a row. Sameet Sarkar has spoken to 15 gas producers and analysts, and now Johnson with the details. Sameet, what are the participants expecting? A steep hike?
Well, yes, a steep hike is expected starting from 1st of April 29.
Excuse me.
See, the prices of domestically produced gas in India is fixed by the government and is revised every 6 months. Now, the poll conducted by Bloomberg Quint suggests that the prices could be hiked by nearly 11% to $3.74 per million British thermal unit. Now, this will be the 4th consecutive hike in domestic gas prices, and this hike will take the gas prices to a near 3.5-year high. However, the gas prices would still be lower by nearly 26% compared to the earlier highs that were close to $5.05 per MMBTU. Now, this hike in gas prices may encourage producers to boost their investments in this sector and to increase their production. So, whom does it really benefit? Well, all the oil producers, that is ONGC, Oil India, Reliance Industries, Vedanta, HOEC, but majorly it will benefit ONGC and Oil India, because if you see in India, they produce and sell nearly 80% of the gas in India. So we have tried to see by how much percentage the earnings per share, that is the EPS, of ONGC and Oil India would have been higher if this new rate would have been applicable last year for the same period, that is in H1 FY19. So we have assumed that the gas sales and the production numbers remain the same. Now, as the production number remains the same, the cost would have been the same for the company. Also, we are assuming that the company pays taxes at the same rate and the dollar to rupee conversion remains the same. So at $3.74 per MMBTU, the company's profit before tax would have been higher by nearly, for Oil India it would have been higher by nearly 200 crore rupees. And if you see, this would have added around 0.8 rupees to ONGC's EPS and 1.2 rupees to Oil India's EPS, which means their EPS would have been higher by nearly 7% and 9%. Now this expected price of $3.74 per MMBTU will be higher than the average cost of production for ONGC, and this will be the first time in last 3 years where this will be happening, which now the average cost of production for ONGC is close to $3.59 per MMBTU, and currently the gas business has been loss making for ONGC. So this hike in gas prices will make the gas business profitable for ONGC. Lastly, whom will this hike impact? Well, it will impact the urea and petrochemical producers, because for them gas is used as a feedstock and their cost of production will now be higher because of this hike. And this hike will also impact the CNG and PNG users, because their cost will also increase with this hike in gas prices. Lastly, it could also impact the margins of power sector and sponge iron industry, where it is used for generation of energy.
Okay, we'll watch out for these stocks. Sameet, thanks so much for joining in today. I'm looking forward to the tutorial at 12 o'clock.
Yes, definitely.
Okay, that's an off-air conversation, of course, but that's what's happening or what could happen to some of the gas stocks. Let's talk about Lemon Tree now. It's looking at an acquisition and looking at the acquisition route to meet its ambitious expansion goals. Now, I'll tell you with the limited information that we have right now, what is it and why is it important, more importantly. Firstly, the news. So they've signed a non-binding agreement to acquire 100% stake in Key Hotels. Now, what is Key Hotels? They own or they operate maybe 21 hotels with 1,911 rooms in 19 cities. So Lemon Tree essentially gets access to this bouquet if they indeed go ahead and make the acquisition. Currently, as per the release from Lemon Tree, they operate about 54 hotels with 5,411 rooms. So if you just do that math, that there are 5,411 rooms that Lemon Tree has, they are planning to expand that bouquet a bit, but based on the current bouquet that they have, 1,900 rooms add about, significant capacity to Lemon Tree. The management has not yet given out the size of the acquisition, and maybe because it's a non-binding agreement, they will definitely not give out how large the acquisition could be. But suffice to say that this will be a large one, just looking at the bouquet that Lemon Tree operates right now versus what it gets if it acquires Key Hotels. Now, before this announcement came in, what were the capex plans of Lemon Tree? That's an important one to monitor as well. So when you look at brokerages, most brokerages say that the current portfolio of owned and leased rooms, which is about 3,400 to 3,600 rooms, they plan to expand it by another 35% by 2021 to 4,800 rooms. Now, why this is important and why there's this dichotomy, brokerages don't look at the managed properties. When they give out these room estimates, they are talking about the owned or the leased properties, which could be to the tune of 3,400 to 3,600 rooms from Lemon property. Maybe with the addition of the managed properties would take the number to 5,400, which the management would be looking as an overall bouquet. But essentially, they plan to expand this owned properties rooms by another 35%. Both two brokerages, Kotak and JP Morgan, have said that. The key is, we do not know if this was a plan, and if indeed they manage to get Key that takes care of the expansion plan, so they're going to expand more aggressively from their own route as well. The Mumbai hotel, which is 300 rooms and one of the largest hotels that was there in the bouquet of Lemon Tree, the commissioning has been pushed back by 3 months to April 2019. This is very well known. It was expected to start in February, but it's now going to get commissioned in the month of April. The pipeline of management contracts, 2,200 rooms, that stays put. But what I'm trying to say essentially is that Lemon Tree, from amongst the companies that have spoken of late, has the most aggressive capex plans, and the acquisition of Keys that they are announced, or the non-binding agreement that they've announced certainly shows the intent of the management. The recent trends have been positive. The ARR growth on a YTD basis for the 9 months compared to the 9 months gone by is up about 8.5%. For Lemon Tree, for other hotels it may be different. For Lemon Tree it's about 8.5%. The EBITDA YTD has grown about 22%, which is pretty strong as well. It's likely to miss the consensus EBITDA for FY19 because of the delay in commissioning of the Mumbai property. Having said that, with the size of acquisition that they are talking about, I wouldn't be surprised if the market would go ahead and feel a bit circumspect about the balance sheet load that Lemon Tree will have to take. I don't think the internal accruals, looking at whatever numbers that I've looked at far on the balance sheet, the internal accruals or the cash on books is enough to make an acquisition of this nature. We don't know the amount as yet, but 1,900 rooms is large, and therefore I don't think that will be the case, but we'll get to know more about it once the management gives us some details. Brokerages by and large have been sanguine. There are no sell calls out here, but because of the uptick that we've seen in the hotel properties thus far, if you look at the ANR function on the Bloomberg terminal, you will see that the return potential is a marginal negative, which just shows that the stock has run up quite a bit and not too many people anticipate further upsides from here. Once the revised notes come out after this deal has been announced, we'll get to know more about it. But watch out for Lemon Tree, could well be a stock in focus today. As also Nestle. That's the third piece on First Word today. 2018 was a good year for Nestle. The consumer staples maker delivered double-digit growth last year, and everything from dairy to chocolates went into the mix. Agam Vakil went through the annual report to find out Nestle's recipe for growth. Agam, what was that recipe first?
Yeah.
And anything else that stood out in that annual report?
Neeraj, you know, among all the companies in the FMCG space, there is one company which goes at valuations which is the same as Hindustan Unilever, and that is Nestle, and for good reasons. FCY 18 saw double-digit growth, saw 11% growth in volumes in terms of tonnage, and we've seen 11% growth in its revenues too. The more important factor here is that its EBITDA margins expanded by as much as 300 basis points to around 21%. And if you consider the way its segments have panned out, well, the likes of your prepared dishes, that is your Maggi portfolio and others, along with confectionery, that is your Nestle chocolates, both of them saw nearly 15% growth on a year-on-year basis, whereas you know, your milk products and nutrition, along with powder and liquid beverages, were just shy of that double-digit mark. In terms of growth, a lot of these factors have played in on and weighed in on that 11% growth this particular year. But what were those factors that stood out for me in this particular annual report for the year gone by? Firstly, it was a margins boost. Let's consider the gross margins, which expanded by as much as 260 basis points to around 59%. And this was largely on account of milk and milk derivatives as well as sugar prices, which remain subdued, and almost 2/3 of their costs are mostly these inputs going in. If you leave that aside, we've seen a lot of cost optimization playing in, and these are some of these other factors which have aided margins for Nestle as far as the year is concerned. Moving on to perhaps the more important factor here is elevated promotional spends, which moved up 44% year on year, and they now comprise of 6.5% of revenues as compared to 5%, and this is the highest that we've seen in 15 years. The real question is, what does this advertising spend indicate? This means that the company is now gearing up for even more growth as they move in. And let's not forget, they have had a host of launches this particular year. So a lot of these launches will, of course, include your cereal breakfast portfolio, which was that maiden foray into this particular category. More variants in the Maggi as well as the confectionery portfolio. So a lot of these factors are playing out in favor of Nestle. Moving on to their distribution. This is something that they have taken a leaf from HUR's book, and this is where your cluster-based approach lies in, where the company has tweaked their products every 100 kilometers. They've taken regions They've figured out how the inhabitants and the demographics of their regions react to products, and that's how they made their changes going in. And that said, they've also cut their distribution centers to 30 from 38, thereby optimizing their costs and also aiding margins going forward. And finally, in terms of their financial metrics, very quickly, the free cash flows rose nearly 17% on a year-on-year basis, which now stand at the cash reserves now stand at around 96 rupees per share. And of course, the return on equity is standing at around 45%. Which is also the highest in 8 years. So it certainly turned out to be a very, very fruitful year for Nestle with the kind of changes the management has brought in this particular year.
Just the one question, one follow-up, Agam. I don't know if you have a number out there, but this 6.5% ad spends that you spoke about, how does it compare to the industry or like-to-like peers? Is it very high or is it at par?
Well, for that, I will need to get back. But honestly, it does vary anywhere between 4 to even 7%. It depends on the strategies that the companies take.
But 6.5% would be on the higher side then?
Most certainly it would be. And for Nestle, it definitely is.
Definitely is. Great. Agam, thanks for putting that into perspective. Well, Agam combed through the Nestle annual report to get us these details. The last piece on First Word today is on the power space. Now, a bunch of these stocks have done very well. However, the sector has been in pain for years. Stock prices of all major power players used to reflect the ache. But as I said, investors now seem to have taken heart from the string of announcements made by the government over the past month or so. And that's reflecting on the index too. Right, Yatin? Good morning.
Good morning, Neeraj. Absolutely, the power sector is in focus. First time in many months is the power sector outperforming the key indices. In fact, if you look at the move which is coming yesterday's move, because of the CPSE ETF launch, we had some correction in NTPC. On a 1 month basis, the power sector has gained nearly 11%. Not only that, this is one of the best March month gain coming in the last 2 years at least. Now, if you look at the power sector, it has posted the best monthly return since August 2018. And if you look at the 1 year performance, the power sector or the power index of the Bombay Stock Exchange was down nearly 9.3%. So a good recovery has come in for the last 1 month or so. Of course, there are a couple of factors that we are going to discuss as to why this rally. Number one is the CERC norms which came in. Remember earlier, a few months back, we had the CERC draft report which had come in, which took final shape a few days back. These norms were applicable for power companies, return on equity and various other things for a period of FY19 to FY24, which means for the next 5 years, there are a set of rules that needs to be followed by power companies, which were more or less favorable for them. Electricity demand is growing at 4 to 5% per annum. We had the power secretary also speak to Bloomberg Quint, and he said that the power demand is growing at a very satisfactory rate, which is close to 5%. Also, we have the consolidation of the power sector, which is happening. A lot of assets have moved to NCLT. There is a lot of stressed power assets which has been tried to be revived by the government incentives, be it the thermal power plants or be it the gas-based power plants. The government and the private players are working to resolve all of these. So a lot of consolidation is happening really as far as the power assets are concerned. And more importantly, the government and the cabinet took a decision that from here on, if there is any default from the state electricity boards, DISCOMs, then the power producers will have a right to terminate the power purchase agreement, which probably is the need of the hour, because I was reading about Coal India, their receivables have been nearly 10,000 crores because of the payment problems by state electricity boards. And similar is the case with power sector, wherein a lot of dues are still pending from the state electricity boards. So now this probably rule comes as a silver lining. Now, if you look at NTPC and Power Grid, these are the two stocks which are heavyweights on the BSE Power Index. They are also, outperforming the markets at this point in time. NTPC, of course, the base ROE is maintained at 15.5%, and Motilal Oswal does believe that this allays the fears of a possible reduction, which was earlier assumed by analyst community when it comes to the return on equity on the base case. Also, the recovery of fixed charge will be computed on the actual plant load factor, which is again a positive according to brokerages like Motilal Oswal and Axis Capital. Power Grid also, if you look at it, the availability benchmark is retained at 98%, which is a positive. And also they will benefit given the fact that it owns more than 90% of India's interstate transmission network after the CERC's new norms have kicked in. Of course, we'll talk about the valuation picture as well. So we have taken 3 power PSUs. namely NTPC, Power Grid and NHPC. And interestingly, to the 5-year average, all of these stocks are trading at a discount. So if you look at NTPC, the FY20 estimated price to earning ratio is 9.6 times versus the 5-year average, which was close to 10.6%. And similar is the case with Power Grid and NHPC. They are trading at close to 10% discount to their 5-year historical price to earning multiples. And if you look at the Bloomberg consensus upside, all of them have double-digit upside, with NTPC being one of those stocks wherein brokerages believe that there could be a 25% upside from the current market price, and also for Power Grid wherein a 14.4% upside is what Bloomberg terminal is throwing up when it comes to the consensus analyst target price on the stock.
Interesting analysis, Yatin. Thanks so much for putting that into perspective. Well, some reason for the power stocks to move up, and if analysts are to be believed, maybe some more upside even after the moves that we've seen already. Let's wait and watch if they come about. That's all that we have on First Word today. Quick programming note, it's heavy focus on markets. We first speak to money market expert Anant Narayan on RBI's latest dollar-rupee swap plan at 9 a.m. Ajay Srivastava later joins in to talk about how he balances the fundamentals and the excitement in the current markets. An extended market conversation to technicals with Gautam Shah of JM Financials at 9:30. Lastly, we discuss the health of the Indian banks with Harsh Modi, the co-head of Asia Equity Research at JP Morgan. After this break, though, a full tilt towards the day's trade. Stay tuned.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome. You're watching Indian Open right here on Bloomberg Quint Live. Good morning, Neeraj.
Morning, Devina. Well, a day of a pause if there's SGX to be believed, but I don't think anybody should complain. It's just astounding the way we moved. It's astounding
we
the way.
said that yesterday also, because SGX Nifty was absolutely flat, and it was just a complete U-turn towards the second half of trade.
Yeah, but since trees don't go to the trees, and since crude has gone up a bit, maybe at some point of time you will have that pause. Could it today be the day?
Which was ignored, which was one factor that was ignored till now, when crude had started to inch up. Probably levels of about 67, closer to 68 is something that people will take notice of.
Yeah, and maybe the rupee strengthening also helps negate that negative impact of crude as well.
Yeah, so rupee back at those August levels yet again, and global markets also picking up. The S&P 500 is back in the bull market run-up. Remember, the S&P 500 volatility gauge has been the lowest level since the month of October last night, and even in terms of the pricing activity, since December lows that it hit, it is actually above 20%. So bull market, a typical bull market will consist, once you start moving up 20% plus, that will constitute your bull market in a single stretch without any big periods of drops of more than 10-12%. So that's what you've got for the S&P 500. The Nasdaq, any which ways, is already up 23% from its low, so that's in its bull market. Can't say so for the Dow Jones, because that's still missing a few percentage points in order to enter into its bull market rally. But that's the performance of the US markets that we highlighted. Asia as a pocket is looking slightly more mixed bag. SGX Nifty, like Neeraj highlighted, is looking absolutely flat. Shanghai is down 1% right now. So no major cues coming in from the Asian markets, at least for now. Let's take a look at what happened in the derivative space. Remember, we've been talking about how F&O participation has been increasing significantly, and that's causing the kind of volume action on the futures and options space. Agam Bakil is joining in with more details. Agam, good morning.
Good morning, Devina. Well, we saw further, advances for the Nifty yesterday, and which means we've also seen a lot more increase in OI. There you have it. This Nifty futures are seeing 3% increase in OI. The Nifty banking futures also continuing to accumulate open interest as much as 12%. The India volatility index, of course, has been relatively stable at between the mark of 15 and 15.5. But in terms of changes in open interest, we've seen a little more writing around the 11,200 and then 300 puts. On the higher end, a little more writing around the 11,500 and 600 calls. So a range has been set between 11,000 on the lower end and 11,500 on the upper end. In terms of changes, we do have your usuals such as IDBI Bank, Jet Airways, Reliance Power and Reliance Infra in the F&O band, but we have a new entrant now, and that's BEML, which joins the list of stocks which are in the F&O band. And in terms of stocks, we're watching out for, Just Dial, Amara Raja Batteries and Apollo Hospitals. And in terms of unwinding, there are a bunch of stocks which stand out. Escorts, which has seen a decline of around 33% in its open interest, longs unwinding there. As is the case for CG Power and Ajanta Pharma, where we've also seen longs unwind. So, mixed cues coming in, and can we expect that to play out today as well? That's a wait and watch.
Right, Agam, thanks a lot for that. That's a quick wrap out from the derivative space. Let's bring in an important market voice then. We've got Parthiv Shah. He's joining us right now with his views. He's the director at TRACOM Stockbrokers. Parthiv, good morning to you. It's banks laughing to the banks. It's like it's just a funny situation to be in, but up until now completely out of the picture. And suddenly, a lot of FII interest coming into all of those big, large banks. HDFC Bank making new highs, Axis Bank, ICICI Bank, IndusInd Bank. I mean, you put a finger to it and you'll find one stock which does well. What would you do now? Would you take profits off?
Good morning, Devina. I was just overhearing yours and Neeraj's talk in terms of yesterday, probably a prediction that markets might not rally. But I think to give full justice to Neeraj's point, yesterday's market rally, if you were to see Reliance and HDFC Bank, only yesterday I would rather say that the market was highly polarized. But rest of the sessions, it is very heartening to see that there was more of a broad-based participation. No doubt the mid-caps, I think, what most retail investors would love to see rallying. I think since the last 2 days seem to be cooling off, and probably now markets waiting for more sanity. I think markets should not, run based on any political outcome. It's at the end, it's all about earnings. But yes, FI's participation and almost to the tune of around $2.4 billion over the last 1 month. And it is obvious, I think there are obvious candidates whenever FI money has flown into a country, names like Reliance, HDFC Twins. And yesterday, I think HDFC Bank, in terms of its contribution, not only to the bank Nifty making new highs, but even to Nifty was significantly high. And we have seen historically, whenever Reliance participates, and Reliance has kind of really, I've seen some fund houses which had trimmed positions in Reliance Industries at 1200 levels, assuming that it's a very expensive stock. And today here it is, I think, even 10% higher. So I think for now, our sense is that market is pricing in a lot of positives, whether we may take it as a political outcome or in terms of the economic data. But my sense is that it is very, very important to have, I think, good quality stocks, irrespective of the valuations at this juncture. No doubt valuations are extremely important, but we need to have stocks at this juncture which will protect our capital. If not, I think go up. So I think that's very important, because generally in such rallies, I think a lot of retail investors tend to get sucked into, and then they get trapped, with stocks which are not having good corporate governance, stocks which are not having good balance sheets. So I think a good quality portfolio construct is very, very important even at current juncture of the market.
Which means you're talking about missing the entire euphoria in the mid-cap and the small-cap space, because these stocks have not been favorites up until now, but the sudden spurt of activity here has triggered a lot of interest, and talks of probably just playing this move on the index and playing this move on mid-cap and the small-cap stocks because of the strong breadth of the market is something that you're saying you would rather avoid?
Not really, Devina. I think in our most of the shows, I think most of the stock recommendations that we have given have been from the mid-cap stable. But what we have focused on, because mid-cap stable is like an ocean, if I were to include mid-cap and small-cap, depending on what definition one gives to the market cap, I think what we have done is we have focused on quality names. I think wherein in terms of the names of the management that we have spoken about, say for example, case in point, in banks, we always preferred RBL Bank. I think quality management, quality franchisee, yet a mid-cap bank. I think it's still not a large cap bank. And many such stocks, Alkylamine, PSP projects, and I think all of these stocks have participated in this rally. But our sense is that it's very important that in mid-caps, if you are going with quality, then one really does not need to worry about timely exits. Because I think we've seen in many of the plethora of mid-cap stocks, I think if one is not able to take profits, I think the same stocks tend to come down a lot. So we are focused on quality management, quality balance sheets, growth visibility. I think that's extremely important. When mid-cap stocks are pricing in higher valuations, I think visibility of having at least a 20 to 25% sort of a CAGR growth over the next 3 years becomes extremely important. That goes by the management's capital allocation policy. That goes by banks, I think, growth targets. And these are very important parameters that we tend to filter out from a huge basket of mid-cap stocks. So no two ways. I think mid-cap, small caps have been our preference. But I think even large caps, some of them have done really well, and some of them even outperform a lot of mid-caps.
Yeah, but I take on board Parthiv's point. The last 3 days, there has been a shift of sorts. Yesterday, the market breadth on the Nifty or the broader markets was worse in the last three, save for HDFC Bank and a couple of other large caps. A lot of index names corrected 3-4% as well. So a slightly different day yesterday, despite the fact that the Nifty levels looked higher.
But we spoke, the conversation with Biju Samuels yesterday about
his view.
Yeah, his view about a critical technical trigger that has come about, which has not happened in a really long time. Two technical triggers, the breakout trust and the breadth trust. Spoke about that yesterday. But he is according to him, every time it's happened in the past, it's moved for a really long period of time, over a year, and it's given returns of more than 30-40%.
Yeah, but if only making money in markets was so easy that sometimes these indicators don't tend to work as well. Parthiv, just one question though on a stock in news today before we get to our research team, because you've spoken about Lemon Tree in the past. What did you make of this non-binding agreement? It's a large acquisition if they manage to do it. Not that we have the numbers, but 1,900 rooms is nothing to scoff at.
Absolutely, Neeraj. I think it's a huge acquisition of sorts, and more importantly, I think the contours of the deal are yet not out. Lemon Tree is a company, we do like this story, I think, no two ways about it. Budget hotel space and the way they've scaled up their business. It's a pricey stock at 43 times EV EBITDA, but nonetheless, I think we do envisage fantastic growth story in this company over the next 5 years. And thus, we believe that the valuations would be justified. But particularly talking about this deal, I think the deal contours are not out. What sort of deal it is, whether it is a payment in trenches, because Lemon Tree already has this 1,000 crore worth of debt on their balance sheet. They do have some projects in terms of execution, and no doubt the business model is transitioning from a asset heavy to an asset light model. But how this deal will pan out, how it will change the balance sheet is very key to me, because in hotel sector historically in the past you've seen whenever managements, I think, tend to be over aggressive, I think that's the point of time to be a little wary. So I would love to hear more about this deal in terms of the how much of a stretch it is on the balance sheet, what sort of value add it has, earnings accretive, etc. Post which I think you can again review the position. But overall, we are bullish on the hotel space, and Lemon Tree is one company which investors should participate.
Okay. Let's wait and watch what happens to the stock today. Parthiv, stay on. So much more to talk about. Let's take it to our research team now to talk about all the other key newsmakers and a lot of stocks in news. Some on media reports, some otherwise, and then some interesting brokerage calls as well. So Mishika and Sameet join in for that. Good morning, Mishika. Good morning again, Sameet. But Mishika, let's start off with you. The stocks in news first.
Yeah, let's look at the important stocks for today. There are a number of stocks. Sony is in advanced stocks to buy stake in Z Entertainment, reports Mint. So Subhash Chandra wants to sell about 20-25% stake at a premium of 30%. He wants to hold at least 20% stake in the company, while Sony is seeking to get around 25% in order to have promoter rights. The amount raised through the stake sale will be used to repay debt of 13,000 crores. Then we have Lupin. Mandideep Unit 1 classified as OAI by US FDA. US FDA may withhold new approvals from plant till it's cleared. Lupin says no new approvals from plant and existing exports can continue. The plant contributes less than 10% of US sales. Analysts are saying that there would be no financial impact, but this could be sentimentally negative. Star Cement receives 115 crores of freight subsidy claims by the central government, expects further subsidy of 42.6 crores in a week's time. And then let's look at Jubilant Foodworks. The promoter Jubilant Consumer Private Limited wants to sell 40 lakh shares. The floor price is at a discount of 4% from the current market price. And lastly, Jet Airways. 5 more aircrafts have been grounded due to non-repayment to lessors.
Okay. Well, we'll watch out. The Jet Airways saga continues, but a lot of other interesting ones as well. And as we said, some on media reports. Thanks for that, Mishika. Sameet, what are brokerages saying?
Well, a couple of them on the brokerage side. Now, if you see, the first one is on Jubilant Foodworks, where JP Morgan has maintained its overweight rating on the stock with a target price of 1,430. Now, yesterday, the company announced their entry in Chinese casual fast food segment. Now, according to the brokerage, this will add to companies' medium to long-term growth drivers. And it also says that they're expecting Jubilant to be prudent and utilize their learnings from Domino's and Dunkin' Donuts stores to ensure a limited impact of this on the financials of this new business venture onto the financials, because if you remember earlier we had seen that the Dunkin' business had been posting losses. So the brokerage is expecting that this new business venture would not impact the financials that much. It also says that Jubilant will, if Jubilant decides to scale up this business, they could leverage the existing scale for this business, which is the Domino's and the Dunkin' business. And the second we have is on Voltas, where CLSA has maintained its sell rating on the stock with a target price of around 500 rupees. Now, in the analyst meet, the company said that the joint venture, that is the Voltec, has seen a good response from the market, and going forward the joint venture will be more focusing on refrigerator and washing machine segment. That's what they said to CLSA in the analyst meet. Now, it also said that the inventory situation is improving for the air conditioning segment, and the inventory has now come down to only 1 month from an earlier 2 month that was seen in December and January period. Lastly, for the project business, the company said that they have seen a steady performance in the project business, and the new return on capital employed for the project business has been in double digits.
Okay, thanks a lot, both of you. Well, Parthiv, a bunch of stocks which are in news. We already discussed Lemon Tree, the other one, and I don't know which way you read this, but Mint reports about how Sony might be very close to. Now, these rumors will keep on flying thick and fast. We already heard a couple of them in the last 1 month too. How do you approach investing in any of these SL Group companies with the current spate of news flow?
See, Neeraj, purely in terms of the business model, I think a couple of these SL Group companies, one is SL Propack, which is one of the market leaders in packaging, along with, of course, Z Entertainment. I think this is a company which did make sort of a bottom, and then with the rumors about an acquisition, and I think probably the intentions of the promoter to kind of try and sell their stake and make sure that they don't have any blemish on their past track record, which is always a good sign. And if at all, I think we've seen many a times, I think historically, I think when such companies or such promoters shift hands, and I think someone as credible as Sony were to enter in terms of even a stake, that certainly helps to build in a lot of confidence. Probably market also envisages a lot more improvement in terms of the corporate governance standards. So I think that should bode well. Not that we want to jump the gun, and now that probably a lot of good positive news would be factored into a stock like Z. But something like an SL Propec, I think that's a stock, no doubt. I think again that has this problem about pledging because of the promoter issues. But again, I think it's a good name, and if at all something like that were to change hands, I believe from current levels and current valuations, it can probably create a lot of value. So no two ways about it. It's more like a high risk, high reward position. But I think the business fundamental has a lot of merit to it.
Interesting. And of course, the other thing is that SL Propack is in that fashion disconnected from the Z group, because while the name is SL, it belongs to a different brother with completely different business interests and no cross-holding whatsoever. So keep that at the back of your mind. This one, starkly different from ZTV or Dish TV or others, no cross-interests, so on and so forth. So that's a different management altogether. The other one, Parthiv, which would be interesting today is Jubilant FoodWorks, right? The promoters wanting to sell stake. It will start off slightly lower. It's been in the news for a number of reasons, with the one action that the promoters took and took it back immediately as well. And the fact that the promoters have been gradually reducing the stake for the last 4 or 5 years. How do you approach Jubilant FoodWorks today?
Yes, my sense is the last thing that the market wants, I think, especially at a stock which is valued at around 45 times FY20 earnings, is any sort of uncertainty or change of mind sorts. I think one thing that we would like to take notice is the increase in the promoter pledge from somewhere around 10%. It's now at 18%. Second thing being, yes, you talked about the royalty thing. Kind of they've retracted that step. But again, now I think talks about the promoter trying to divert their energy into a Chinese food joint. I think that is something where I think investors might tend to get slightly wary, and more importantly, the institutional investors, which are heavily betting on Jubilant Food for the Domino's story. I think not even Dunkin' Donuts, but it's all about Domino's Pizza, I think. So it's going to be very important to see what the management talks about based on this new venture. And I think there's always a fear that, management would land up spreading its bandwidth way too much. And about the pledge, I think that's not a little comforting sign for a stock which is quite richly valued. So at this juncture, I think our call is, let's wait on the sideline. Let's see how the results pan out going ahead. And again, I think these stocks do tend to have huge, I think, correction moves. And valuation also in the past we have seen tends to get derated when any such thing happens. So I think it's better not to get carried away with the story right now and just kind of wait on the sideline. I believe one would get better entry points in this company.
Okay, stay on, Parthiv. So much more to talk about. Let's get in our technical experts on board and start off with Rahul Randeria. He joins us right now with his thoughts. Okay, I have a lot of stock-specific strategies from Rahul. Rahul, no index trades?
Yeah, I have index trades, but if you look at on the daily charts, in the last 3 to 4 weeks, Bank Nifty has rallied almost 2100 points. If you look at Nifty in the last 2 weeks, we have seen that Nifty has rallied more than 600 points. So definitely, if you look at the price and the price setup on the hourly charts, it is getting a little bit heavier. So we could see some sort of exhaustion or profit booking at the current level. So at for maybe 2-3 days, I would recommend to book profit at the higher levels, or even those who want to go short at the higher levels, if there is a flat opening or maybe a 0.25% a gap up opening, it should be used to go short at the higher levels. On the downside, I feel on the Bank Nifty, on the downside, I feel that Bank Nifty could test the level of 28,400 on the downside, and one should place a stop loss above maybe 29,150. On the Nifty, maybe one can go short at current levels, and on rallies maybe 30-40 points if there is a rally.
You'll go short when it starts off flat.
Yeah, if anybody who trades with multiple lots can go short at the opening, and even on the rallies can go short at the higher levels. So stop loss in Nifty would be maybe 11,450 or 11,460 on the spot. And on the downside, I feel that Nifty can test the levels of maybe around 11,200. So definitely we could see some sort of exhaustion of profit booking at the higher levels. So I would be a little bit cautious going long at current levels.
Okay, we'll wait for your stock specific strategies, but we'll just quickly get in Sameet Chavan as well and get in his index view. Sameet Chavan, Chief Analyst for Technical and Derivatives at Angel Broking, is joining us on the show right now. Sameet, a quick take on the index first off, Nifty, Bank Nifty.
Hi, morning. See, if you recall, last Thursday we were somewhere around 11,000 and we had a flattish kind of opening, a minor dip in the initial trade, but we were of the opinion that this is not the decline wherein you should go short. In fact, use such declines to go long. and we have already formed, on daily chart, Nifty has already formed megaphone pattern, and our targets, we were quite vocal about the targets of 11,350, 11,400. So Nifty around those levels now. From here on, yes, we might have some kind of profit booking or consolidation, but our stance remains the same. This is not the kind of market wherein you should go short. Rather use such dips to go long, because again the trend, trading against the trend becomes very difficult. So use such dips to go long. At this juncture, we don't have any trade in index, but we would rather keep a close eye on important levels. On the low side, 10,300, 10,277 would be an immediate support levels. On the higher side, 11,400 is the level to watch out for. So we might see some kind of consolidation, but at this juncture, it would be a prudent strategy to go long in individual stocks that are clearly providing better trading opportunities.
So slightly more divergent views coming in there on the Nifty from both our technical experts. But Sameet is of the opinion that he doesn't want to go against the trend that's currently prevailing on the indices. Individual stocks then, and Rahul, I'll start off with you. You have 3 stocks and you're selling all of them: SAIL, Sun Pharma and India Cements.
Yeah, definitely. As you rightly said, I have 3 sell calls. All 3 stocks are into overbought territory, showing some sort of exhaustion at the high levels and some sort of a negative indication on the daily charts. So definitely for short-term basis, if anybody wants to trade, or swing traders can go short in SAIL in the range of 50 to 65 and on Analyst to 54. My downside positional target is 47 and one should place a stop loss above 56. My second sell call is in Sun Pharma. Yesterday we have seen that in the last leg, many of the pharma stock got beaten down in the last maybe half an hour. So definitely we could see some sort of profit booking in pharma sector as well. So I have selected Sun Pharma. Swing traders can go short in Sun Pharma on rallies to 463. My downside target is 435 with a stop loss above 476. My third and final call is in sell in India Cement. Again, the stock has rallied very sharply in the last very short span of time in the recent past, and yesterday we have seen some sort of exhaustion just above its 200-day moving average. So we could see some sort of profit booking in India Cement. Those who have bought at lower levels can try to book profits. Even anybody who wants to trade fresh can go short in India Cement in the range of 103 and on rallies to 105. My downside target is 92 with a stop loss above 108.
All right, Sameet, what about your stock specific strategies?
See, all 3 longs, as I said, we would still go long in individual stocks that are providing better trading opportunity. Very seldom, we see such kind of momentum happening in individual stocks. If you see in last 6-7 months, the broader market was clearly underperforming, and the kind of bounce back rallies we are seeing, it is very difficult to trade against the direction. So mid-cap index, which has already broken out from a triangular pattern, 6-month triangular pattern. So any dip would be a good buying opportunity. We are long in KTK Bank. We have been quite upbeat on the entire mid-cap private banking space, be it KTK, RBL or DCB. And we have been bullish on KTK since the level of 112. We are riding this move, and yesterday we saw good bump up in this counter. So we expect this rally to extend. 137 would be our immediate target now. One can go long with a stop loss of 125.8. Apart from this, MGL, which has been consolidating off late since last couple of days, we have seen good buying interest at low levels, and yesterday toward the fag end of the day, this stock managed to confirm its breakout. Hence, go long with a target of 995. All our positional levels, stop loss at 878. And final buy call would be on Bharat Forge, which remains our preferred bet since the level of 485. We are again riding this momentum on the higher side. 568 would be our target now. 524 is the stop loss level.
Okay, so those are some stocks to monitor in the session from a trade perspective. Parthiv, the last few days, as we discussed, banks have done well, but it's not just banks. Some of the NBFCs have done remarkably well. Looking at Ujjivan, for example, 1 week, 1 month, 3-month performances, all of them looking very strong. The last 1 month, 23% up on a couple of percentage points yesterday. Edelweiss is back to 180, 185 as well. I mean, I'm not even talking about Bajaj Finance, that's another league, but the mid-size NBFCs have all moved up. Are they factoring in normalization too soon, or would you be sanguine and would you go out and buy one of these?
See, I think Neeraj, a lot of these big credible managements, I think of late, they have been talking about the liquidity related position of slightly easing. And for good quality NBFCs, I think no doubt the cost of raising new paper has gone up almost by 100 basis points, even for a AAA rated paper. We saw a case in point with L&T Financial Holdings, whose issue was nicely oversubscribed. Raising funds for these people is not an issue, but I think a lot of these managements have very prudently, I think, been very conservative in terms of their disbursements since the last couple of quarters, which I sense is a very good strategy for future, because I think their liquidity position tends to improve, and there is certainly demand. I think for their lending, there's certainly a lot of demand, but I think they've cautiously cut back, which is good, because once the position improves, and now I think the bond market is also showing good signs of things easing out, then I think these companies will be in a fantastic positions to increase the level of their disbursements. And I won't be surprised we'll see in some upcoming quarters where the level of disbursement tends to go up very aggressively. So I think it's a good prudent strategy for the long term, but I think nonetheless it's going to be still a little shaky period for the next 3 months, post which I think a lot of interest should emerge back. But I think in terms of some credible names, certainly L&T Financial Holding is one name. Edelweiss is another name which I think after this recent correction looks attractive, but one will have to give at least a 3-year horizon for these managements to come out of these problems, and I think again show a lot of value in terms of their balance sheet growth.
Interesting. What's happening with some of these textile names, Parthiv? Indocount up about 18%. We've seen a bunch of others do well too. Himmat Singh Seed, related name, related sector, but the last few days have been very, very strong. Are you a buyer in any of these, and why so?
Not really, Neeraj. I think in the textile space, I would still want to wait on the sideline. I think a lot of these companies were looking at some sort of export-related jobs from the government. But I think so far we haven't heard anything as such. And I think there's a lot of competition for many of these textile players internationally from places like Bangladesh, Vietnam, etc. And I think no doubt a company like, say, Himmat Singh Seed, I think is into a lot value-added linen-based products. And I think they have a credible presence in the US, and so is the case with many other textile exporters. But we haven't seen these companies, I think, deliver very good set of numbers of late, and that's the key reason why we are not seeing these stocks really perform. So I think I would wait on the sideline. Even for someone like Himmat Singh, the stage 2 of the expansion is still in the pipeline. But I think at these junctures, I think it's better to wait on the sideline for these names until more clarity emerges in terms of change of its business metrics.
Okay. Some stocks which are at 52-week highs, and Parthiv, if you track them, if you have any thoughts on whether people should buy, sell, hold. CESC Ventures, the newly demerged name, 583 was up 10% yesterday, doing rather well. As is Solara Active, about 7%, 421. Lastly, Chalet Hotels at 4.5%. We already discussed hotels, but Chalet Hotels individually clocking in new highs.
Yes, I think these three stocks have been buzzing, Neeraj, but I think to be very honest, I think based on the futuristic outlook, the scalability of the business models, I think we are not very gung-ho on either of these three names. So I think I would take a pass on these three.
Interesting. Okay. But the stocks have done really well for themselves. CEC Ventures is a newly demerged entity housing the 2Yum brand, amongst other things, holding company into First Source and a couple of other businesses of the CEC group. And Solar Active, the API business. Chalet Hotels, of course, again a newly listed company, but the management confidence was palpable when they spoke to us, not doing allied activities, sticking to the hotel business, but the last 1 month with a 15% up move, doing rather well for itself. Sameet, Chavan, any thoughts on any of these? A couple of them are newly listed names, so I don't know how much history you have, but if you can pull up the charts and talk about any of these.
No, it would be very difficult to comment because the historical data is not that sufficient, so I'll not be able to comment much on this stock.
How about Info Edge? That too is at new highs. It's not a very liquid name, but if you can pull up the charts and tell us something about it.
No, clearly this stock has been enjoying its multi-year bull run, which started way back in 2016, and since then there has been no stopping. We have been seeing series of higher top, higher bottom formations. Any minor dip in this counter is clearly getting bought into. So those who have bought it at lower level, they should certainly ride this momentum. as far as trend goes, this stock has been maintaining its sturdy structure. Now 1700, 1740 would be seen as immediate support levels. So those who have bought it at low levels, those who have been riding this stock since last many months, they should now trail their stop loss somewhere around 1700 and stay put in the stock.
Rahul, what about a Yes Bank? Now it's crossed 240. It's been a slow creeper after that big move that it got post, its RBI divergence report announcement. But what's the sense here?
Yeah, if you look at the daily charts, the stock has been moving slowly and gradually towards its 200-day moving average. And yesterday it has just made a high around those particular levels. Volumes are also encouraging, but if you look at the oscillator front, they are also slowly and gradually inching towards the overbought territory. So maybe some sort of more upside is left, maybe 3-4%. So I would be looking out for the levels of maybe 255 on the higher side. So maybe for swing traders or maybe for those who want to trade for 2-3 days at 10 rupees up move, one can trade with the current market price with a stop loss below 238. The risk reward would be 1:1. So definitely yes, the momentum is positive, but I'm not looking out for a very big upside. But yes, 255 could be on cards in coming days.
Okay, we've got 30 seconds left to go for market pre-open, so we'll stick to cues coming in from Asia. So far, nothing major happening there. Asia is a pocket, slightly more mixed bag. Nikkei is positive, but you've got China trading under by about closer to 0.75%. Hang Seng absolutely flat. And for the SGX Nifty, no major cues coming in either. Pretty similar in terms of the cues that came in yesterday, with SGX Nifty not moving at all, just staying put. 11,386 on the SGX. More importantly, we're going to see what happens to the currency and the bond market yields when it opens up for trade on the back of the RBI dollar-rupee swaps that they have announced to the tune of $5 billion. That's the Nifty 50. We won't talk more about the indices because they're extremely volatile at the start of pre-open. It's more about stocks, and we'll talk about them. HDFC Limited has started moving up, so that stock's about 2% higher. Ultratech Cement is up 1.8%. Bajaj Auto is up 3%. Indian Oil moves up 1.45%. Eicher Motors is up. You've got Z, which has moved up to 1.25%. Yes Bank at 247 now. So L&T moves up to HCL Tech. You've got India Bulls Housing 708. Grasim, HDFC Bank continues to move up. Wipro moves up, Z moves up, but no a big bang move on the stock. Hero MotoCorp, ITC, SBI, BPCL, Reliance Industries now once again is up, but marginally, 0.1% higher. A handful of about 10 stocks in the red, but the largest loss comes into Hindalco, 3.5% under, followed by Power Grid, which is down about 3%. That's what the index is showing. So almost 40 stocks advancing and just 10 stocks in the red. Currency has weakened from yesterday. 69.53 was the close. We're at 69.71 this morning. So some weakness coming into the currency. Bond market yields, a reflection yesterday was closer to about opened at 7.35-ish yesterday, and today's open is somewhere closer to about 7.37. Remember, the RBI has announced that they're going to be looking at injecting liquidity into the system through dollar-rupee swaps to the tune of about $5 billion. We will be talking about this. In fact, we've got with us Anand Narayan. He's joining in. He's the professor at SP Jain Institute of Management and Research. Anand, thanks very much for taking out the time. An initial comment on this particular move by the RBI, replacing OMOs with this dollar-rupee swap?
Morning, Devina. I think RBI has expanded the number of tools that it uses to manage rupee liquidity. So far, it's been using open market operation, purchases and sale of bonds, as well as long-term repos against bonds. Now it's extended it explicitly to the currency swap market as well, and this time for a longer tenor. I think it's a welcome move. You shouldn't be putting all your eggs in one basket. And this should bring in money directly into the borrowers in many ways, because rather than just bringing down bond yields, this should make it cheaper for people to borrow in foreign currency and swap it into rupees. What this means for markets, first off, it should be negative for government bond markets, because as you indicated, the expectations around future OMO purchases by the RBI come down. Second, this should bring down the cost for importers to hedge term currency payables. Essentially, since the RBI is receiving forward premia, markets will bring down the forward premia. And lastly, this should make it, as I mentioned, cheaper for both banks as well as corporates to raise money overseas in dollars and swap it into rupees. Now, a lot depends upon where the RBI accepts the cutoff. If it's substantially lower than where the market was yesterday, that could mean a good rally in corporate paper as well, especially the good quality corporate paper for the shorter tenor. So all in all, this should reduce the cost of funds for the system as a whole, but it could increase the cost of borrowing for the government bonds.
Just to draw a parallel or draw the difference between the two modes that the RBI has used, that's the OMO and now the dollar-rupee swap. From a market standpoint, which would have been a preferred mode for the injection of liquidity?
A lot depends on the quantum, Devina. So look, so far the RBI has purchased about 75% of this year's net borrowing program by the central government. That's a substantial size. Now, obviously, OMOs are favorable as far as the banks are concerned because banks hold substantial amount of government paper. And it's also very favorable for the government because its cost of borrowing comes down despite the fact that its fiscal deficit has actually expanded. This, however, doesn't necessarily mean that the cost of funds for the system as a whole comes down. In fact, we've seen that in the recent past where even though bond yields have been capped because of RBI OMO purchases, the cost of funds for borrowers, both through corporate bonds as well as through borrowings from banks, has actually remained pretty high. In a sense, using swap market now, reverses that impact a little bit. It cheapens the cost of borrowing for corporates and for end users. But at the same time, it increases the cost for government borrowing. So this mix is probably good. And at a time when the rupee is actually showing signs of appreciating, cheapening the cost of importing might actually bring some parity and balance back into the currency market as well. So overall, I think the mix is good. It's more a question of what tools you use to what extent rather than the reference of one tool over the other.
I was about to ask you that, Anand. Good morning. Just one question from my end. What happens to the currency because of this move and even otherwise, the last few days of strengthening? For how long can we expect that to continue?
Morning, Neeraj. So look, by itself, this move should cheapen the cost for importers to buy forward dollars. Now, normally you would expect that's weak for the rupee or weakening for the rupee because you will see or you should see more importers coming in. However, the current mood of risk on towards India is pretty strong. Over the last few days, all Indian asset classes have been factoring the possibility of a stable government coming in after elections, which has been good for our asset markets. Plus, specifically for the currency market, there's also buzz about one-off large flows coming into the system, possibly because of certain distressed assets being purchased by overseas investors, as well as possibility of money being infused into large rights issues. So, and typically the first quarter of a calendar year tends to be good for currency flows. All this put together means that the overall mood for rupee remains reasonably positive, and that might be enough to offset the weakening impact that you would normally see from the lowering of forward premium.
All right, the currency has come off from 69.7 that it opened at. Just one last question before we thank you, Anand. At the time that the currency had started moving towards 73, 74, the RBI had, in a sense, started to sell dollars to make sure that the currency doesn't weaken any further. Is this a good way to shore up those forex reserves?
Well, I think the clearly stated intent is not really to worry about the forex reserves. It's more to infuse rupee liquidity. In that sense, this is very, very different from the swap which was offered in 2013, where the intent was clearly to shore up dollar reserves. Look, I like the fact that they're using multiple tools to manage rupee liquidity. I was personally uncomfortable with the size of the OMOs being done, even though it was good for bond traders. Too much of government bond was being bought by the RBI purely for infusing liquidity. Also, in a sense, I think while the mood for the rupee is pretty strong right now, in real effective exchange rate terms, we are again getting into dangerous territory where rupee is probably overvalued by about 16-17% now. And let's not forget, we have a large fundamental core deficit because our current account is still not healthy. We are still pretty poor as far as exports is concerned, and we're importing too much of oil and electronics, etc. To that extent, allowing the rupee to weaken naturally is probably a good idea, even though the mood right now seems to be bullish for the short term. In fact, I would strongly recommend that importers start to hedge and buy insurance given the current favorable conditions.
Hopefully people are listening to that as well. Anand, thanks so much for taking the time out and joining us this morning and giving us your thoughts.
Thanks, Neeraj.
That's the view from Anand Nayan, professor at SPJ of Management and Research. The currencies just weakened ever so marginally. In fact, maybe started off lower, but now doing okay. In fact, the pre-open rates have settled too for the equity market. So let's just talk about that for a bit, because we haven't spoken equities morning. The currency was the big factor. About 1/3% in the green, so not a bad start. The broader market, the Nifty Bank again leading the charge, about 0.5% higher. But I must say that the broader markets are a lot more tempered. The top loser is Quality with a 4.5% downtick. The top gainer is Diwan Housing with a 5% uptake. So no big moves that are happening at the broader end of the spectrum right now. Just want to mark what Jubilant FoodWorks is up to. That's that one key stock to monitor in the session today. Not really starting off dramatically lower. Well, let's wait and watch how the start could be. Power Grid is starting off 3% lower though. Do watch out for that one. Rahul, quick 30-second view. Power Grid amongst the top losers today on the Nifty 50. The last couple of days has been slightly weak. What do you do here?
Yeah, if you look at the last 2 days of candle, previous day was, means day before yesterday was a inverted hammer. Yesterday was a bearish candle. And we have seen the stock has rallied from the levels of 172 to 202 in the span of the last 3 weeks. So definitely we could see some sort of profit booking, but not major downside is seen. From current levels, I feel that the stock could settle down around the levels of maybe 188 or 187. So one can book profits and again try to re-enter at those levels. The nature of the stock is a slow mover, so definitely not major trade is there, but anybody who wants to trade for maybe for a couple of bucks, maybe 6-7 rupees, so definitely can go short at the current levels for a target of 186 on the downside.
Okay, minute 7 from Market Open. Let's tell you all that you need to know to stay ahead in trade today. First up, Jubilant FoodWorks. Promoters of the company plan to sell 3% equity via an offer for sale. The floor price of 170 rupees at a 4% discount to yesterday's closing price. Promoters are expected to raise over 500 crore rupees post the sale. Lupin's Mandideep facility gets an official action indicated notification from the US FDA. The authority stated that the pharma company will be subjected to regulatory action and may withhold approval of any pending application in which the facility is listed. Lemon Tree Hotels has signed a non-binding agreement to acquire 100% stake in Keys Hotels. Keys Hotels owns and manages 21 hotels with 1,911 rooms. This will add to Lemon Tree's hotels' current portfolio of 54 hotels with 5,411 rooms. According to Mint, Sony is in advanced talks to buy a stake in Z Entertainment. Promoter Subhash Chandra looking to sell 20 to 25% stake, a premium of about 30%, but he wants to hold on to at least 20%. Sony, on the other hand, seeks at least 25%, which would allow it to have promoter rights. Lastly, more trouble for Jet Airways as another 5 planes have been grounded due to non-payment to lessors, and that stock continues to grind lower. Parthiv, actually coming out here, a quick thought here. Jet own issues, SpiceJet, the DGCA order ready, meaning some more issues. Is all of this Indigo's gain? It certainly seems to be the case. My question is, will it result in stock price gains fundamentally? Will that be that big a kicker that the earnings would move up dramatically?
Certainly, I think, Neeraj, if you see the stock price of Indigo has been rising without any change in certain fundamentals, and that's probably because of all the pain that its competition has, is certainly currently a gain for Indigo, because if in terms of calculating the number of Boeing jets that Indigo has, I think it's nothing, and I think their fleet is quite secure. And if at all there is this rule to ground, I think a lot of SpiceJet's fleet, I think again will bode very well. And off late we are seeing this pricing power emerging, I think, for these airlines. And we have always recommended Interglobe Aviation trying to go with the best, the one having the best market share and the best cost metrics. And I think, yes, Indigo has done well, and I still believe, I think it's one of the best plays if one wants to stay in the aviation sector for a longer horizon, then this still seems to be the best play.
Okay, so that's the verdict. Well, Interglobe Aviation certainly had a big move in trade yesterday. Sameet, Chavan, what about Indigo on the charts? There are certainly some tailwinds. Can it ride them? Do the charts show that?
Yes, clearly it gets reflected in prices as well. This has been one of the steady movers within the aviation space. If you look at the other performance from the other peer counters, since last 3 months the stock has been moving steadily higher. A series of high top, high bottom formation, and couple of weeks back there was a breakout from its multi-month resistance level. So from here on, this stock would continue its outperformance. And in the near term, we could see the stock heading towards 1350, 1400. So minor dip from current level would be a good buying opportunity in case of Indigo.
Okay. Do watch out for this one too, and watch out for some of the specialty chemical companies. They've started their move up again. I think SRF, if we can blow up the pre-open session, that stock at about 2417 is closing in 52-week highs. Some other stocks include Diwan Housing, which is looking like starting off well about 5% higher. So some names certainly have a bit of action in the session today. Okay, less than a minute left. Let's take in the top calls from our experts. Sameet, Chavan, to you first. Your top call for the day.
See, for me, KTK, MGL, both would be my top bets. But if I have to pick any one, I would certainly go with MGL. It has come out of its concession zone. Target 995, stop loss 878.
A top call.
A sell call in ICICI Prudential rallies to 338. Stop loss would be 345, and downside positional target would be 320.
Okay, so buy call in MGL from Sameet Chavan and a sell call in ICICI Prudential from Rahul Randeria. Sameet as well as Rahul. Gentlemen, thank you so much for joining in today and giving us your thoughts. Appreciate your time. 30 seconds left for the markets to kickstart trade. Parthiv, just stay on. We'll take in some opening thoughts from you, a top call from you, post-market open. But expect the markets to start off in the green yet again. So the Indian markets are well defying what the Asian screen shows almost every single day. Not that there is a sea of red today, but still we are starting off another 0.5% northwards for the Nifty Bank if the pre-open rates are to be believed. So good going really. Pull up how we started off. So the Nifty 50 about 25 odd points, about 100 points for the Sensex and the Nifty Bank. Actually not a 0.5% move, just about 1/4%. So let's see if this moves last or do they correct. The broader markets didn't do too well yesterday. Let's see if they're starting off in the red today. No, actually tick off green and a decent one at that. Northwards of 1/3 of a percent for both the mid-caps and the small-cap indices. So it's not a bad start at all for the broader markets too. The market bet seems to be positive and we just about holding on to that 0.2% kind of gain. But a fair degree of green, very little red. That's the key thing. Firstly, let's talk about the red. It's essentially the PSUs, so Power Grid, HPCL, BPCL. We spoke about the possibilities of this yesterday. And the last 2 days, the PSUs have taken a bit of a breather. In fact, have come off as well. Bharti Airtel, second day in a trot, comes down a little bit in the session. And commodities look slightly off with Hindalco, Reliance and a couple of others looking slightly wobbly today. What's doing well? Z Entertainment, I guess courtesy that newspaper report that came out, about 1.7%. Indiabulls Housing and Yes Bank, both of them moving up in tandem. Coal India, some gains, but aside of that, nothing too dramatic. So Power Grid on the losing side, or PSUs on the losing side, and Z Entertainment and Indiabulls and Yes Bank on the gaining side. That seems to be the order of the day. What about some specific pockets? I wish I can pull up Jubilant Foodworks just once out here because the Jubilant block deal has been done in the block window, not in the open window. But let's just see if the stock price is reflecting that. Jubilant Foodworks, no, not quite. It's doing really well for itself, so well absorbed. Fair call. We'll of course discuss more about this. Just a couple of pockets of strength or weakness that I want to mark in the session today. And let's pull up some key movers from yesterday's session. Firstly, so Indocount, Just Dial, BEML, these were the top 3 gainers yesterday. And Indocount, another 3.5%, is just having a really strong rally the last few days, about 60% in the last 1 month alone. Strong moves out here for Indocount for sure. And secondly, while we're talking about the movers and shakers and what's done well and what's not, you can't take your eyes off stocks which are trading near 52-week highs. Chalet Hotels, CESC, Solara Active. Solara another 6.5%, really strong show. Devina, what are you spotting?
You should pull that stock up to see what that stock's doing in trade this morning. Post its non-binding agreement with Key Hotels, the stock reacting 1.2% higher, not that big an impact on the stock. Diwan Housing Finance is the other one that you need to watch out for. With their whole stake sale, and now there are some murmurs of how the NHB has cleared them with regards to all of those charges. The stock's up about 5% odd. JM Financial 4.5% higher. Suzlon Energy 4.5% higher. Remember yesterday's session saw some profit taking on Suzlon. Today's session is up 4.5% yet again. Avanti Feeds 3.5% higher. Yesterday saw a little bit of a drawdown, but today is back up in action. Motilal Oswal 3.5% higher. Then should pull up, while GM Financial, Motilal Oswal should pull up IIFL and Edelweiss also to see how these two stocks are doing within the same pocket. So IIFL is also up about 2.33%. Edelweiss, which has had a roaring last few days, is up once again about 1%. Trident is up closer to 3.5%. Himmat Singh Seed, which has been an active stock over the last few days, is up 3% in the morning session as well. So doing well. MTNL, the last 1 month is up 15%, but over the last 7 odd days, the stock has started to take a beating. Manpasan Beverages should pull the counter up. Yesterday's big 20% move today sees a follow through of about 1.5% in early morning trade. PVR has moved up 1.25%. Prestige Estates 1.25%. You've got an Aurobindo Pharma. You've got Gati. Should pull up Jet Airways, Indigo. Both these counters yesterday were in focus. We spoke about how Indigo, key likely beneficiary of these 737 MAX aircrafts getting grounded. Into Globus up 1.3% yet again. Jet Airways, another 5 of its aircrafts getting grounded for non-payment to lessors. It's down about 1% yet again, about 238 for Jet Airways.
But strong show by the HDFC twins, Devina. They are leading the Nifty Bank higher, up about 0.5%. Parthiv, before we thank you, you mentioned at the start of the show that you've been bullish on the mid-sized names. One stock recommendation before we let you go, something that you're telling your clients to buy right now.
Sure, Neeraj. I think this company is DCM Shriram, and we know for the fact that they are into 3 primary businesses. One is caustic chlorine, second is their door business, which is a good brand, and I think the frames, plastic PVC based product, which is for home building, and sugar business also. I think they have done extremely well. It's a stable business, and they have some capacity additions there, and things are looking up there as well, and a small cement plant. So I think these are all the businesses in this company which are housed, which are more related to the old economy and more about, I think, the demand, the economic cycle picking up. And I think the management is very efficiently, I think, increased the capacities, and I think they've modernized a lot of their capacities, as a result of which we are seeing the return ratios coming out extremely well. So I think this is a company which, I think, if you see the last 5 years sales track record, it has been somewhere around 10 to 12%. But I think the profit has scaled up hugely by almost 50% CAGR over the last 5 years, and I think the valuations currently are not at all demanding, and I believe that this can be a good stock to ride over the next 2 to 3 years, trying to play the story about the chemical segment through caustic chlorine, and also I think it's other divisions which are firing up well. So I think this is something, but yes, I would like to put in a note that, you know, this is a company which needs to be monitored quarter on quarter, and also the prices of caustic chlorine need to be monitored. So the timely entry and exit in such counters is very, very important. So one can't just say that just buy it and forget it for 3-5 years. But yes, over the next 2 years, the business outlook is extremely appealing to us in this particular counter.
Parthiv, just one more word on the auto pack. Yesterday we had a conversation with the chief at FADA, and he said that things are not yet improving on ground. Inventory levels are continuously piling up in the passenger vehicle space and even in the two-wheeler space. Too early to take a call on what the rain brings in for tractors and trucks, but at least on the other side of the spectrum, things are not looking all that great. What's your own sense?
See, yes, I think the auto sector has been struggling with this inventory issue, and we had this very tepid festival season, post which generally the demand is never very strong. And now I think generally into March, we always know for the fact that the discretionary spend is very tight because of things like advanced tax. And yet I think there are not like any signs that we are seeing which tends to show any sort of pickup. And even historical trends suggest that, you know, generally going into the major elections, I think the sales trend is kind of tepid, and the money flow overall in the economy is a little tepid. So our sense is that it will take still next 3 to 4 months for, I think, the sales to base out. And I still believe that we might see upcoming months, I think, not being very good. And based on the year-on-year high basis, we might see many companies, I think, disappoint in terms of the numbers. And we are seeing this because of the heavy discounting that the automakers are trying to roll out, and yet the sales are not picking up. So the scenario is a little precarious, and it will take at least 3 to 4 months for things to stabilize. And only post-elections, one should again try and review many of these companies in the auto space.
All right, got that. Parthiv, thanks so very much for joining us this morning. Appreciate your time. Ajay Srivastava, Managing Director at Dimensions Corporate Finance, is joining us on the show as well. Ajay, good morning to you. And, what a time to get you in at,
good morning.
in the sense as to what the markets have been doing over the last few trading sessions. Last 10 days particularly have been absolutely fantastic, even from a market breadth point of view and the broader market point of view, which has started to make this move look slightly more structural. What's your sense?
Well, I think we all need to just send a thank you note to Jerome Powell for getting us this lovely rally at the end of the financial year. It was a lousy year for most investors and portfolios, so I think it's been a really, really timely relief. So that extent, I think they're all smiles all around. We're not going to quibble with any rally whatsoever. And it has obviously come from the overseas shows. We may think it's an electoral issue, but obviously it's liquidity coming. And the numbers are very clear. Domestic investor is smartly selling. The overseas guy is buying on cheaper money. So it's kind of a very nice way to structure the market because everybody gets what they want. The foreign investors with the money ETFs get what they want. The large cap shares, the Indian investors are finding a good exit out of the share they were stuck in. So I think all in all, I don't think it is structural rally. I think it's a purely liquidity driven rally. It's rally focused on a lot more of the big cap names. The fact that the domestic market, some little momentum has come in the small cap doesn't make it widespread because there is no follow-up buying happening here. This is a market where at the lower end, it's all about sell on rally, not buy on rally. On the other side of the market, it's all keep buying the large caps. Nobody's selling them because they have shown phenomenal results. So structurally, the market is very clearly differentiated between the top end and the lower end of the market. And I think we need to just take it as it comes because trying to justify it on fundamental, very difficult. Trying to predict a rally, again, continuing, very difficult. You've seen the oil prices, you've seen the GDP growth numbers, you've seen all around the numbers, capital formation. So I think for the time being, just let's rest with the honest answer that there is a lot of buying coming from overseas cheap money on the large cap side. It's the mid caps which are giving you liquidity. Take it off your portfolio if you can.
So in the month of March, when the mid caps and small cap indices have given 8 and 10% returns, what according to you has driven that? I mean, if you're saying much of the liquidity that has come in has gone into the larger, more stable names and the cheap money, now that the currency is back at about 69.5, that makes it slightly more lucrative for FIIs as well to start pumping in more money. What has led to this move on the mid cap and the small cap end then?
See, I think if you look at the mid-cap, small-cap index, it always happens. When the large caps rally, there is definitely the gap, the valuation gap, which changes with the mid-cap and the lower cap. So they need to kind of come up along with that. And obviously, since the discounting was much higher, you will see a disproportionate increase, 9%, 8% rally in a month, which always happens in the small and mid-caps. Having said that, I think that's why I said that in a rally like this, it gives a liquidity to the stock. More than the price is liquidity, because if you were to sell the mid-cap, maybe some time back, you couldn't offload of 100,000 shares or 50,000 shares, etc. Today, you possibly can, because people are betting the fact that if the gap between the large cap and the mid cap has to go back to where it was before, these prices have to move up by 8 to 10% at least for the gap to come back. So I think it's, as I said, it's a pure play on the liquidity in the market, where we are seeing the large cap zooming away and therefore mid caps are being pulled up along with that. It's not fundamentally that the people are buying it, it's just that the valuation gap makes them move up along with the market. Nothing else happens in the market but the fact that people say, the gap is 30% on the PE, so if 30% has to remain, this price has to go by 10%. Fair point, fair issue, people can take calls, but doesn't give you a reason to buy into the stocks in an economy which is at 6%.
Right. And the macro data also slowly but steadily starting to shift towards the other side. Ajay, just wanting to get your thought on one more aspect, and that has been the overall sectoral impact that we've been seeing and how we've been trying to move from, the defensive pockets that were favorites. If you're already down one quarter for the calendar year 2019, this quarter, the first half, at least in the first few months, was more defensive. So your pharma, your IT, currency was still on its way to getting stronger, but it was still more about those stocks. Now the sudden shift has become high beta. It's become more banks, it's become more infra, and all across the body, whether it be the larger names, whether it be the smaller names. Going forward into the next 3 quarters of this calendar year, how would things change depending upon various variables that will affect it?
Okay, our view maybe is still standard, remains where it is, not changed, that in the next quarter, you'll be find the most negative surprises is going to come from the companies you just named, the infrastructure sector, the road companies, etc. They will give you the most negative surprises because quite obviously, first of all, at the last fiscal end, the government ran out of money. So, the payments have not been coming through in the most PSUs and the most funded government institutions. So very difficult to believe that large sums of money will be released by the government to these companies and government contracts. And they're only government contracts most companies are doing at this point of time. Now go to the step to the next quarter. Next quarter, nothing going to happen because by the time the results come out of the election, it's going to be May 23rd. By the time the cabinet gets formed, it's going to be May end. So, no matter which way it works out, this quarter, the government doesn't have liquidity. The next quarter, there is no government to give orders to. So you will see a 6 months hiatus in the fortunes of this company. Yeah, sure, you can bet the stock and says, why am I betting on only 3 months? I need to bet on a year or 2 years or 3 years. That's a fair point, absolutely. But whether we look at repositioning this sector in the next 2 quarters, I don't think it will happen with anything fundamentally. It's going to get worse because liquidity is going to get worse. The ability to do projects is going to get worse. There will be hardly any buying taking place, no new orders coming through or less orders coming through by and large. So nothing changes for these companies except it gets worsened as the election cycle comes in. On the contrary, now what's happening on the other side of the fence. The other side of the fence is the consumer, the so-called old defensive name. Now they're no more defensive. A PVR or a Titan are no more defensive names, or a Nestle's of the world, a Bata's. They're no more defensive names. They are strong, aggressive growth stories eating up market share every month, quarter to quarter. And you're seeing it happening. So, we have to also change our mental paradigm. What we used to call earlier defensive stock have actually become growth stock, and what we call momentum stock actually have become a government dependent stock, almost like a quasi PSU stock. So, in terms of investor orientation also, we need to start looking at stocks a little differently than what we used to do in the past, saying all consumer is this thing. Healthcare is a disaster. No, don't even go near it. It's not going to rechange. Prices are already being getting frozen, medical devices under control. This is a absolutely quagmire where you want to make money out of the pharma stocks. Leave it to the PE funds who are coming in investing it. It's not for the investors. Pharma has not made return in 5 years now, and there is no reason to believe it will change. So let's stick to what earlier what was called defensive had now become growth, and stick by it.
Okay, interesting. Ajay, just one final question from my end. Did I hear you say that you would book money out of those liquid mid caps?
Sorry, repeat the questions.
Did I hear you say that you would book money out of select liquid mid caps while the opportunity presents itself?
Of course, absolutely. At the end of, if all works well, I think we have to go back to the roots where we were 2 to 3 years or 4 years back. 3 to 4 years back, the route was 75 to 80% was large caps, and 15 to 15% was the larger the mid cap. Now, I don't know where you would call a company like SRF with a 2,000 crore turnover, or a company like DCM Shriram consolidated as a 1,000 crore turnover, 2,000 crore turnover. Would they become as mid cap or semi large cap? I don't know the stock. But certainly, for sure, that anything below 500 crores, you got to be gambling with it. Maybe a few percentage of your portfolio goes there. But if you can, we don't have anything in that category by and large except a couple of defense stocks. But if you have, I think that's the place to exit, because this liquidity opportunity window comes only once in a while. In the last 1.5 years, people have got a bloodbath on the stocks with no liquidity. Even when you want to get out, you can't get out. Now, such a market gives you liquidity. So yes, use that liquidity not to get in, but to get out.
Okay. Some words of caution by Ajay Srivastava. And I hope people are taking note of that. Ajay, always a pleasure chatting with you, and thank you so much for giving us your time today as well and talking to us.
It's wonderful having.
Yeah, thanks. Same here. Well, so word of caution from our fundamental experts. Now let's get in, a noted technical voice as well to talk about his thoughts on how the near-term and the medium-term charts look like. Gautam Shah of JM Financial should be joining us in moments from now. Okay, I think we do have him. So Gautam, good having you. Thanks so much for taking the time out and being with us. I was looking at your notes, and while you were bullish the last few days, your early morning note today seems to suggest that you expect a period of consolidation. Can you elaborate a bit here?
Yes, Neeraj. I think, it's been a phenomenal run in this last 10 days. As I always say, the best of rallies come after a period of real challenge. And I thought the period of December to February was a real challenge at the markets because you had the Nifty trade in a band of about 350 points. You had a lot of crisscross action. Market participants were pretty confused as to which way the move is going to happen or the snap out is going to happen. But I think we were pretty clear all along that it was a phase of consolidation. The market was fed with a lot of bad news to end with the geopolitical developments. And despite that, the Nifty managed to respect support levels. And I think that gave us an indication that this market eventually wants to break out on the upside. So we were pretty prepared when that move started to happen from around 10,900. And we were working with a bare minimum target of about 11,350 to 11,400, which is where we are right now. So it's been a nice 500-point rally in a very short span of time. And as the Nifty gets closer to 11,400, I think you could see the first bout of profit booking. So when I say consolidation, it could just mean sideways action for a few days. I think once that sideways action gets absorbed, once the weaker hand selling gets absorbed, you should see the next leg up. This uptrend is just going to continue for many weeks to come, and we are working with the Nifty actually going on to a level of 11,700 in this move itself. And eventually, possibly before the election results, we could be even hitting a level of 12,000. Because I think this snap out has happened after a lot of hard work, and it's not going to end in a hurry. So any small dip of about 50, 100, 150 points, which can happen at any point of time, I think is a buying opportunity. And the Nifty seems to have created a very strong base or a floor in the 11,000, 11,100 area.
Gautam, the higher beta, would it come via betting on the banks which are looking the strongest or the Nifty, or would you reckon that the broader markets have a higher probability?
Well, Neeraj, that's a very important question because everybody seems to be running after the banks. I think we have maintained all along that the banks would be the first mainline index to hit lifetime highs, and that has happened yesterday. We were working with a target of about 29,000, and it's a humongous rally for the Bank Nifty, 2,500 points in a matter of few weeks. So I think the risk reward is just not justified to be going long on the banking stocks at levels of 29,000. So the first leg of the move is generally led by the stocks which did not do so badly in the difficult times. So if you look at that period when the Nifty was in a 10,600, 11,000 band, the banks actually did very well. The Bank Nifty was absolutely flat, if you remember. And now as the Nifty has snapped out, the banks have been the best performer. But now I think people will realize that there are much better bets in the markets. And I think some of the other sectors might actually take leadership. Not to say that the banking rally is coming to an end. I think our bigger picture target for the Bank Nifty is about 30,500. And we see that coming in the next a few months. But just for the near term, I think there could be some consolidation, even some correction, which is, pretty par for the course given the kind of rally that we've seen. So around 27,300, 27,500, the Bank Nifty seems to have created a nice base for the rest of this year. And keeping that in mind, I think I would be a buyer in banks on some dips. But in that space, I would actually look at the PSU banking space because, they are now recovering at a greater pace. Some nice base building setups we've spotted in the banking space, in the PSU banking space. So that's a pocket that we like, along with some of the other themes in the marketplace.
Interesting. Gautam, if indeed there would be a dip that could come in, we can't time it, but let's say in the next month and a half, if we do have dips, will these dips be shallow or could they be pronounced, or is it difficult to say that?
Well, Neeraj, I think the dips will be shallow. I think, one major catalyst for this market running so fast, in such a short span of time is the stubbornness of the bears. I think if you really look at the derivatives data, you will understand that there are now too many people waiting for that 100, 200 point dip on the Nifty to come. People don't realize that for almost 3 months, the Nifty did nothing. It gave you 5 or 6 opportunities, by going to that zone of 10,600, 700. Those opportunities have gone by, and I don't think you're going to have very large dips in the marketplace. So when I say shallow dip, a 100, 200 point dip can always happen. It's nothing in percentage terms. But as I just said, 11,000, 11,100 according to me is a strong base. I don't see that being violated in the next 4 to 6 weeks. So keeping that as a floor, at any point of time, there is a smallish dip. I think that's a buying opportunity for a much bigger target. So while we are working with 12,000 as our target for the next, couple of months, I think at some point of time, by the end of this year, our long-term target for the Nifty has been around 13,000. So if you really look at it from that perspective, even at 11,300, 400 levels, there is a lot of money to be made. And I think people should not get out cheaply. I think there is this thought process in the market that it's run up so much. So should you book profits for once? My answer to that is do not book profits. Stay the course. I think there is much greater gains, to be made. And I think just about every factor is working in favor of equities, whether it's currency with the rupee appreciating beyond 70. Oil seems to have stabilized. Global markets are looking up once again. Domestic flows have been excellent, and that's only helped our markets through the troubled times. So every possible factor is in favor of equities, and it does seem as if politics is also going to go the bull's way. So keeping all of this in mind, I think this is a great time to be in the equity markets, and one should make the most of it.
Okay, the strategy for the day from JM Financial seems to be BPCL, so keep that at the back of your mind. But as I look at the note, the buying opportunity, Gautam, as you say, is in the healthcare space. Now, can you talk about this a bit? Would you buy? What would you buy within this? What levels would you look at? And would you buy the heavyweight components of the healthcare index in a lopsided way? How would you play this?
Well, healthcare is a very short-term play, as you read it out from my report. So that's really just for the next 1 week. But on this call, I would really like to talk about the bigger picture. And I think from a bigger picture perspective, we are not so very kicked about healthcare and IT. The reason being, these were the defensive bets in the market when we were going through challenging times. And now, all the insurance bets that were there in these two spaces is actually now moving out to high beta. So I would want to believe that the autos will make a comeback, capital goods will make a phenomenal comeback, oil and gas stocks will do exceedingly well over the next few months. So these are our bigger buy and hold themes, which we are recommending to our clients for the next, 4 to 6 weeks or maybe even longer. Healthcare is more of a short-term view, I think, just for the near term, because many stocks in the healthcare space are just only now breaking out of strong patterns. And because the Nifty is at a minor resistance, there is a possibility that some of the other sectors take a little bit of a rest, and healthcare, does well for the near term. So this is purely a 1 week kind of a view, and there could be gains of about 3 to 4% in some of the popular stocks.
Okay. What would you do with the large cap banking names? The IndusInds, Axis Banks, and the HDFC Twins, all of them have moved up. Which one looks primed for more upside here, Gautam?
Well, I cannot talk about specific stocks, Neeraj, but I think as a space, it continues to look excellent, because if you look at it on the weekly and on the monthly charts, there are no indications of a top out. I think look at what HDFC Bank has done in a matter of 7 days. Such a big heavyweight name, and it moves like a mid-cap. So it's just spectacular, the kind of run that it has seen. But I think some of these stocks, which are a little over-owned, might not be able to maintain the same pace of upside. On the other hand, if you look at some of the other names in the banking space, which have made a good comeback, you alluded to Yes Bank, I think an Axis, an ICICI Bank. Some of these banking stocks have been in a range for many, many months. In fact, an Axis Bank has broken out of almost 1.5 years of doing nothing. So I would actually look at some of the laggards. I think the laggards will in the next 2 to 3 months, and the poster boy names, might not do so well. So they might be market performer, but the other laggard names would be market outperformers.
Okay, so bullish Gautam Shah, and it's always good to hear such tones at a time when people are making money. So Gautam, good having you today. Thank you so much for taking the time out and speaking to us, and look forward to have you more often on our forum.
Thanks.
That's Gautam Shah of JM Financial, sounding extremely bullish. And banks certainly seem to be one of the spaces where he believes that there could be upsides, even if he believes that some of the overall names may not really continue the party. Let me put it that way. Will they do that or no? And what about the overall health of the banking system? We'll discuss that in greater detail with an expert voice. Harsh Modi, the co-head of Asia Equity Research at JP Morgan, joins us on the other side. Stay tuned.